Yeah. Want to call the, oh, I got to stay here. It's the second time I said that. We want to call the special finance committee meeting of Wednesday, November 8th, order at 9 a.m. Roll call, please.
Mr. Legess,
Present.
Mr. Vickery, Mr. Washington, Mr. Stauffenberg, Mr. Hess, Mr. Mulcahy, Mr. Scott,
Present.
Mr. Seroy,
Present.
Mr. Hildebrand,
Present.
Mr. Einfeld,
Present.
Ms. Weber,
Present.
Mr. Payton,
Present.
Ms. Dunbar, Mr. Ritter,
Present.
Mr. Kinzinger,
Present.
Mr. Wheeler,
Present.
Mr. Lear.
Present.
We have a quorum.
Okay. I have no public comment. Is there any public comment this morning? Okay, we'll get right into it. We're first on the agenda is the 2018 health insurance renewal. Mr. Lynch and Mr. Dave.
I'll get it in a minute. Get this out of there. Insurance.
Bring your coffee, okay? Bring your coffee. Yeah. As long as it's not there. Other than coffee.
Didn't answer that question.
Okay, you're on.
Very good. I think we're going to kind of go in reverse order here from the bottom up rather than the top. And I'll let my partner here, Dave Underkoffler, give you some of the easier items first, and then we'll get to the medical last. All right. Well, I guess I'll start with our vision, or let me start with dental first. The dental plan, which we have, we've looked at the rate, the claims experience and all the data. Last year, that one had a 2% increase, and we're looking at that saying our recommendation is not to increase the dental at all. The next thing we have is the vision plan. We did get a slight increase from VSP. It was a 6.3% increase. We checked the marketplace for that. That seems still to be the most competitive vision plan out there. So our recommendation on that is to keep that in place. The next thing was the flexible spending account. There was an increase in the cost of the flexible spending account. It's up 11 cents. So it was $3.75 employee. Now it's $3.86. And we are changing the benefit. The IRS is allowing that benefit to go up a little bit. So we are suggesting that we change that benefit from up to $2,650 this year. The next thing is the life insurance. Received a small increase in the basic life insurance. We didn't receive any increase in the supplemental life. If employees want to buy that, those rates are still staying the same. But on the basic life, the $10,000 that the county pays for, there was a 2 cent raise per thousand. So the county currently pays $1.20 per employee. That is going to $1.45. That's the same rate as it was 3 years ago. And with this $1.45, we got a 2-year rate guarantee on that rate. We did send that out to other carriers. We got 4 major carriers that we sent it out to. Nobody had better rates. I think one carrier actually matched the rate. It all has to do with the experience. We've had some claims and that. So currently the life insurance is running about 211% of claims to premium. So it looks like that was actually a justified rate increase. And so our suggestion is to just renew with Dearborn National for the life insurance. Supplemental life also is running at a negative, but they didn't raise those rates, so those are staying the same for the employees. And so that brings me to the health insurance. So when I talked for the finance committee last time, I said, well, we were looking at, I started with a 28% rate increase. We got that down to about 19% through United Healthcare. We had quotes from Blue Cross Blue Shield as well. We looked at different plans available through United Healthcare. We looked at different funding mechanisms. Does it make sense to go self-insured? We looked at United Healthcare for that. We looked at, actually got another a self-insured quote from another company, and then we got Blue Cross Blue Shield. Came back and we presented 4 different scenarios. And based on the 4 different scenarios, the one that we're recommending is that the county drop the HRA, the health reimbursement account, and offer 4 different plans. And I think everybody has the 4 different plans that are available. With these 4 different plans, we looked at the benefits that are available to the employees. We think they're keeping them fairly close to what they have. We were able to get the rate increase down, what the board can expect to pay, and still offer the employees options. So what you have there in front of you, we're calling option 1, option 2, option 3, and option 4. And if I just skip to option 2 and option 3, those 2 plans are currently offered to the employees, so we're not changing those 2 plans at all. We have 23 employees enrolled in option 2, and option 3 we have 28 employees. Option 2 is a qualified high deductible health plan, so employees that choose that offering can have a health savings account, and the county currently funds part of that health savings account for the individual. If you're a single person covered, the county puts in $500 and they put in $1,000 if you have more than 1 person covered. So any kind of family coverage, you get $1,000. That plan is a $5,000 deductible and then 100% plan after you've hit the $5,000 deductible. That did receive a rate increase from last year, but still looks like a pretty viable plan. Has our core network, which seems to be pretty good for everybody. I think I'm going to say 95% of the folks at least have that network, and that seems to be working out just fine. Both hospitals here in town are in the core network, so we didn't change that option at all. Option 3 is our HMO plan. Again, our HMO here offers both hospitals in the network, so you can choose which hospital you want to sign up for. With an HMO, you sign up for a primary care physician, and that primary care physician coordinates all your care. So basically, you'd say, oh, I like the Riverside system, or I like the St. Mary's system. We have 28 people in that. That looks to be, since we have both hospitals, basically all the docs, in town on one side or the other, that seems to be a very good option, and one that I think we need to really educate the staff and employees about, because I think that's a really, really solid option for them. And that kind of is our base rate, what we're looking at there. That's our base plan now, because that gives them some like type benefits that they're used to: $1,000 deductible, a drug card, an office visit copay, all those things that they've had available. We've had this plan in place for a year, but to offer a plan with those type of benefits and basically freedom of access for any hospital, any doctor, whatever, is just getting very, very costly at this point. So what we did, we have option 1 now and option 2. We kept option 1. Option 1 has the Choice Plus network. We know that there are a few people that want to use certain hospitals in Chicago, and so we kept that plan with that network. Now, when that plan came out this year, currently that plan has a $2,600 deductible. We had to change that to $2,700 because of IRS rules to make it a qualified high deductible health plan. Now, in order to get the price down on that, however, we could no longer have it a $2,700 100% plan. That rate was a 28% increase. That's just too costly for anybody, for employees and certainly for the county. So we took that plan and made it a $2,700 deductible, then an 80/20 after that, with a total out of pocket out of $6,350. So we think that that's probably targeting those few individuals who need the most broad network or want the most broad network that United Healthcare offers. And then option 4 is very similar to a plan that we have now. Currently we have that $6,000 deductible, but we have a health reimbursement account that we throw $5,000 at, so basically netting that down to $1,000 deductible. Our recommendation is we can't afford to do that any longer with these big kind of rate increases that we have. So we looked at offering a plan that still offers a office visit copay, still has a prescription card, but keeps the premium down. So that is our option 4. It's a $5,000 deductible, 80% after that, Total out of pocket is $7,150. That's what we had to do the plan to get the rates down under $500. Our target for the single rate was somewhere between $500 and $510 to come in where what we looked at for budget. But again, if you took that plan, option 4, at least, and if you're someone who just go to the doctor a few times, you have your doctor's office visit, and you have a drug card with that plan. So we look at the 4 plans that we're offering now as opposed to the 5 plans, or 4 plans we're going to offer in January, our recommendation, as opposed to the 5 plans now. And basically, it just, with a 28% rate increase, even getting it down to 19%, we had to make some changes, we thought, in order to make this palatable, budget-wise, for both the county and for the employees. So what we're looking at for the employee portion, for example, is they'll be able to find a plan. If they're in the least expensive plan, they may pay another $10 for a plan. But if they're in a more expensive plan, they're actually going to see more money in their pocket take home. So depending on which plan they choose. Our target plan, we think, should be the HMO plan. Again, that HMO plan, you're offering both hospitals here in town, and depending on which, if you sign up for the Riverside piece or the St. Mary's piece, you should be able to find your primary care in your hospital in network. I think when I was here last time, I said, well, what we were looking at for 2017, the total, what the employees pay plus what the county pays in to the health insurance was about $4.6 million. Think of that, the board paying about $3.5 million and employees paying about $1.1 million. With this new scenario, we're projecting right now that the board will pay just over $3 million and the employees about $1 million. So the total will be about $4,043,000. So that's using a $510 individual rate across the board for everybody. Of course, if they chose option 1, the board pays 75%. The employees pay 25%. That isn't changing, can't change by contract. So if they chose option 1, the board would pay a little bit more. If they chose option 4, the board would pay less than that. But we figured the average would be somewhere about $507, $508 per employee, if that's the single rate. Again, that's 75% paid by the board.
I wanted to stress a couple things Dave's gone over. Why is this rate increase to begin with so high? And at some points, sorry about that. Some points we had some good rate experience on a month-to-month basis, and it turned bad about the 4th, 5th month of the year. As they did the renewal, the county was sitting on an average of about 106.7% loss ratio, which is about 6%. They paid out 6% more money than they took in. So after the rate increase, then we went to the marketplace. We had Blue Cross and we had these self-funded plans that we were looking at. United quickly came off that 27.8 or 28% down to 20, or I guess it was 19 point, just a little under 20%. So then we had the revisions to do, and the only choice you've got at that point, because you've got this 75-25 scenario, is altering benefit designs. You can't do anything else because contribution strategies don't come into play. You can't do spousal waivers as an example, which we heartily suggest. That's a big deal in the marketplace because when the Affordable Care Act came in, everybody expected that they would move spousal coverage back to the spouse's workplace. And in many cases that's happened, and it's helped immensely certain accounts who had high concentrations of either double covered spouses or just spouses, covered when they had access to other coverage. And the other coverage I'm talking about is the new marketplace that was supposedly existing out there. So, it's very difficult because the only choice you have here is to create a new benefit plan that meets also certain standards that were in the scope of the contracts. So besides the 106.7%, you've also got this other issue of high claimants. And of that, we had 8 high claimants above $50,000 this year. The bad news is they took up a lot of room. 20% of the people on the group, cause 80% of the claims. It's an old statistic in the marketplace, but it's the truth. The good news is that 2 of the $50,000 folks, one of which very high in the 400 or 500,000 range. We don't know who that is, by the way. It's a HIPAA privacy, but we know that it was a very high claim amount. Has gone off and has become primary under Medicare because they had a qualifying disease to go onto Medicare. So that's good news. One other person went off the plan, so I presume that person might have been 65 and took advantage of different options in the marketplace. So the sad part about this rate experience is that we had several months of good experience, and then we get to this end and we see the 106%, but the month that they did the experience run, the experience actually ran at 220% of total. And so every time you think you're getting a step ahead, you take a step back, and that's the sad part about it. But it's not a cut to anybody in the sense that, what exists, and this is what we have to deal with. And so, I wish we had some other options relative to contribution strategies and some of these other things, but that's down the road. So I think people are going to be satisfied if they look that the $1,000 deductible is still there. We were able to manufacture a plan in such a way that it can be kept. And the other 3 plans, as Dave said, 2 of them are very similar, and others we've altered to get the prices down. So just another perspective. And, hopefully as we go into this next year, we can get some better experience, because that's what dictates the total.
I guess we'll open it up for questions.
Yeah.
Any questions on anything anybody has? Plan designs or costs or our thought process going through this?
Mr. Stauffenberg?
Thank you, Chairman. Not a question as much because I was on the committee, but I think you made the comment in committee that 33% of our claims are coming from the spousal.
Absolutely. I don't like the reporting mechanisms we get in fully funded accounts, because you've got this HIPAA privacy scenario that can maybe lead someone to conclude who, a person might be, as an example. Where in self-funded plans, you get all the data, so you know that. But the one piece of data that they do have that's pretty good is that how much did the employees cost the plan, how much did the spouses cost the plan, how much did the dependents cost the plan. And the 2 numbers I remember were the 33% Jim just spoke about. That was part of the total claim amount in the previous 12 months. And 17.9% for the dependents, meaning mostly children, things of that nature. Or I guess it's the only part of the nature. But the point of reference is the dependent child scenarios don't generally cost you as much as some of the spousal claims. And when you look at the demographics of the case, it's kind of a little bit over the 35 and up into the 40s. So the population's aging is where I'm going, and everybody knows that many times when you got an aging population, you have some higher claims. But that's where I was saying earlier, the spousal waiver scenario. One account that I'm very familiar with used it, and it dramatically plunged the next year the claims for the spousal issue, and got many people who had been some of the highest claimants off the plan. And those are the kinds of things that we're talking about. It's not to penalize somebody. If you can't get coverage one place or another, certainly you're welcome to put your spouse on a case. But the problem is that, there's many people that have coverage elsewhere that could go there, and all they have to do is just take advantage of it. And we'd like to see that and that scenario develop in the negotiations that come about. So
That was my comment, is that we need to be thinking about that in our negotiations for the future. And, I don't even know if the people realize when you're double covered like that, they're going to coordinate benefits, so you're not getting the full force of what you're paying for anyways.
Somebody has, said to me the other day, well, I thought it was double coverage, meaning, you get paid twice. And I go, no,
Not hardly.
you don't get paid twice. You get paid once, and then you turn around and turn what didn't get paid into the second carrier. And you got to pay your deductible again. You got to pay your coinsurance again. And so it's of no value, it's more trouble than it's worth, to be honest with you. But you're right. These are things that are being done in the marketplace every day that we see, and unfortunately, you just can't take advantage of them. So it is an issue that has to be addressed. It should be addressed.
Thank you.
Anybody else? Andy?
Excuse me, one question. We're kind of talking about just making people aware in the county, the employees, that migrating from the HRA, which is where a majority of people are, into the HMO may be sufficient for them as far as the network goes. Just quickly, I know we were talking about it. Is that for a family? It's roughly $100 a month savings, or I think it was $94 savings.
Well, I did the calculations, Andy. I forgot to include that in some of the comments I made. But had we done nothing, left things the way they were, and accepted the rate increase, it was going to cost the single approximately $526 a year more than they were paying, on their portion of the contribution. The employee and spouse is about $1,103. Employee children was $903, and the family would have been $1,584. So even for the 25%, that they're going to be paying significantly more money. So it's not just because of them; it's because of the expense in total that we have to control this. But as we ended up seeing here, it's about a $425,000 or $50,000 savings by going this direction, as opposed to to staying with what we had and gutting it through, so to speak. So I mean,
Yeah, and even comparing it to current, because I was just doing some math here. If someone is currently in that HRA plan and they have family coverage, they're paying $236 every paycheck to be in that plan. In the HMO, with our new rates, it'll drop down to $191 for the full family coverage, $191.61 per paycheck. So that's $80 a month, $900 and some dollars a year in their pocket. And I go back, and I know I keep saying this, but I think it's worth stating that with education, when people realize that they have both hospitals in town, when they have all the docs in town through the HMO, I think that with education, I would be surprised if we don't have at least 100 employees choose that option. Once they realize, my hospital's in there, my doctor's in there.
and facing the question directly on, people say HMO versus PPO. There's a different stepping method you have to in HMOs that you don't. In PPOs, you just take whoever's in the network and you go to them. In the HMO, it's a little bit different, only in the sense that you've got to pick a primary care doctor, which in the PPO, you don't have to formally do it, but you do the same thing necessarily. You go to your primary care doctor. Primary care doctor sends you out from there with a referral. And the positive about this, and the federal government even looked at this, at a portion of the ACA planning process, and was thinking about mandating some of these HMOs developed in there, is that there's a stronger, control mechanism. And meaning that, the primary care doctor has a great incentive to make sure that you're being treated in not only a medically proper way, but a medically cost-effective way. So we think there's a couple of positives there. And when we do the education meetings, those are the things that we're going to be trying to explain and want people to realize. It's not really a hindrance. I talked to a girl yesterday who called about a separate question. And she says, I've had no problems. She goes, as long as people understand what the mechanisms are, meaning, getting a referral if you're going to go see a specialist, as an example. And there's some real positives in this plan. The drug card's the same. The office copays are the same. You just don't have to go through now the HRA process, which, by the way, it was a great mechanism. I think it outlasted its purpose, meaning that we strung it along as far as we could, but when the experience hits the fan, so to speak, then you have to look at something different. You can't just keep doing the same thing over and over. So again, I think when they see it and they're educated, they're going to feel a lot better about it.
And Mike touched on a good point there, because we actually looked at, well, last year we took the HRA plan and we took it from $5,000 up to $6,000 and said, hey, let's just bump up the HRA. So basically push more risk onto the county. Well, we've pushed that about as far as we can push it. We said, hey, can we do a $10,000 deductible? But we can't do that because it's a fully funded, it's a fully funded plan, and you have to stay within ACA guidelines, with the Affordable Care Act guidelines. So an insurance company won't give us like a $10,000 deductible. So to push up the deductible to get savings in our premium and say, well, maybe the county could take even more risk, we weren't able to do it. We were almost up to the limit on that anyway.
And the last comment I want to make, we mentioned that we got some self-funded quotes. No, I'm sorry.
How do you structure the educational meetings that you have with?
We have, Lynn comes up with a calendar of meeting times and events. So we'll go to different places, Sheriff's Department, Circuit Clerk, and each one of those meetings runs somewhere between 45 and 60 minutes per.
Okay.
And then after the fact, we're there for questions and answers. And if anybody's got any questions during the meetings, they're all very informal, but we try to stick to a script, so to speak. And
Right.
here's this part that you ought to realize that's different, and do the education at that point in time.
Now, we're bringing someone down from United Healthcare to help explain. Unfortunately, they're all voluntary meetings, so we can't.
I know.
Yeah, we'd love for everybody
Right.
to come, but it is what it is. That's why we try to spread it around, have different locations at different times.
But I wanted to make a last comment about self-funding. All of the people on the prior committee knew we were looking at self-funding. Every time that we got to a point where we thought that something might be workable, it's all involved about cash flow. And when you've got costs down for a while and they're below where you're at right now, that's great. But I guarantee you they're going to go up. There's going to be a strong bell curve at some point, and we know that the experience is not running absolutely well. So there are going to be some highs. And Andy called your finance director in. We sat down, we talked about it, and there's just no way that the county at this point in time could afford to go that route. And I've heard it said, well, why don't you go self-funded? Well, the reason we can't right now is because, we don't have that ability to suffer these bells and curves, or these highs, so to speak. Now, down the road, I think Andy would make the point, and I think I heard him say that, in 2 or 3 years, that might be very possible. And then you've got some options on the table that you don't have right now. And there's a variety of things that can be done positively, and I think to affect the plan. So just in case that comes up, I'm just giving you, a perspective on that too, so.
Mr. Chairman. To that point, the self-funding, it's not like a $6,000 deductible. The stop loss would be around $50,000. And so if we have 2 of those hit in January, February, when we don't have much cash, that's the problem. If it were to come after July, we might be able to deal with it a little bit better. But unfortunately, the year is structured the way it is. So that's why we have to wait until we have more of a cash reserve to enter the self-funding mechanism. It's just 3 years is hopeful. I would say it's probably gonna be more like 5 or 6, but we'll start looking every time this comes around. So I'll mention that.
Anybody else having questions on the medical? Okay.
Thank you.
Yeah.
Thank you.
Okay, we're gonna have a roll call vote on each component separately. So the first one will be to renew the dental with Delta Dental at the same as last year. We need a motion and a second. Mr. Washington? Mr. Vickery with a second. Any discussion?
Sorry, is dental on the agenda?
I didn't see it on here.
I just don't know.
I kept trying to find it and I didn't see it either.
On the second page.
on the agenda?
No, we were looking on the agenda. It lists Vision, Life, FSA, and the Medical HSA.
We should vote on it, but I think let's do it at the full board meeting. No, on
This is finishing up.
the next full board meeting.
3-year term.
That's next Tuesday.
So we had a 3-year guarantee, we're in our 3rd year.
Oh, we're in the third year of the guarantee.
Oh, so we don't need to vote
I
on
thought it was the
that.
first year of a new.
Okay.
I apologize. Okay, we're fine.
Okay. So the next one would be the VSP Vision, and that stays the same also, so we'll need a motion. Motion by Mr. Scott, second by Mr. Payton. Roll call vote.
Mr. Legess,
Aye.
Mr. Vickery, Mr. Washington,
Aye.
Mr. Stauffenberg, Mr. Hess, Mr. Mulcahy, Mr. Scott,
Aye.
Mr. Seroy, Mr. Hildebrand, Mr. Einfeld, Ms. Weber, Mr. Payton, Ms. Dunbar, Mr. Ritter,
Aye.
Mr. Kinzinger, Mr. Wheeler. Motion carries.
Okay, the next one would be the renewal with Dearborn Life. That went up slightly, 24 cents raised per thousand. We'll need a motion and a second. Motion, Mr. Scott. Mr. Vickery with a second. Roll call vote. This is on Life, Dearborn Life. Okay.
Mr. Legess,
It's 2 cents.
Oh, okay. Sorry about that. Okay, yeah.
Mr. Legess,
Aye.
Mr. Vickery, Mr. Washington,
Aye.
Mr. Stauffenberg, Mr. Hess, Mr. Mulcahy, Mr. Scott,
Aye.
Mr. Seroy, Mr. Hildebrand,
Aye.
Mr. Einfeld, Ms. Weber, Mr. Payton, Ms. Dunbar, Mr. Ritter,
Aye.
Mr. Kinzinger, Mr. Wheeler. Motion carries.
Okay, then I believe the the second to last would be the FSA, the flexible spending account. We'll need a motion and a second. Mr. Washington with a motion, Mr. Stauffenberg with a second. Roll call vote.
Mr. Legess,
Aye.
Mr. Vickery, Mr. Washington,
Aye.
Mr. Stauffenberg, Mr. Hess, Mr. Mulcahy, Mr. Scott,
Aye.
Mr. Seroy, Mr. Hildebrand,
Aye.
Mr. Einfeld, Ms. Weber, Mr. Payton, Ms. Dunbar, Mr. Ritter,
Aye.
Mr. Kinzinger, Mr. Wheeler. Motion carries.
What's the last one?
Medical.
Okay, now we have, I don't know how you want to put that in the motion, just the 4 plans, is that how you want to put it?
Yes, I should want to.
Okay. Next will be the medical, the 4 plans, options 1, 2, 3, and 4. We'll need a motion by Mr. Stauffenberg, second by Ms. Dunbar. Roll call vote.
Mr. Legess,
Aye.
Mr. Vickery, Mr. Washington,
Aye.
Mr. Stauffenberg, Mr. Hess, Mr. Mulcahy, Mr. Scott,
Aye.
Mr. Seroy, Mr. Hildebrand,
Aye.
Mr. Einfeld, Ms. Weber, Mr. Payton, Ms. Dunbar, Mr. Ritter,
Aye.
Mr. Kinzinger, Mr. Wheeler. Motion carries.
The HSA next? Is that part of the medical? Okay. Okay, so that's the 4 we needed to vote on. Next up is approval of the 2018 tentative budget. You got something?
It was part of the health plan. What did we do last time?
We've done it in the past.
It is a separate line item on here, so we might as well just make sure we're covered. It's on the agenda. So. And see, I think you're right, yeah, we have done that in the past. We're going on as a separate line. we have done that in the past. We have voted on it as a separate line on the budget, so.
Okay,
I'd make a comment too, that you're just continuing $500 deposit for the single and $1,000 for the family in.
he's not on the microphone.
Correct, only that one. It's option 2, 500 and 1,000, just like we did last year. Not the second HSA option, just for that one. So motion, sorry.
Okay, we'll need a motion and a second for the HSA. Mr. Stauffenberg and Mr. Vickery with a motion and a second. And we'll have a roll call vote.
Mr. Largess.
Aye.
Mr. Vickery. Mr. Washington. Mr. Stauffenberg. Mr. Hess. Mr. Mulcahy. Mr. Scott.
Aye.
Mr. Searoy.
Aye.
Mr. Hildebrand.
Aye.
Mr. Einfeld.
Aye.
Ms. Weber. Mr. Payton.
Aye.
Ms. Dunbar. Mr. Ritter.
Aye.
Mr. Kinzinger. Mr. Wheeler. Motion carries.
Okay, we'll be approval of the 2018 tentative budget. Steve, you ready? Or what are we doing? Yeah.
I'd just like to say thanks to Dave and Mike on their hard work, along with the committee. This is a tedious job going through all the options. And they've sure taken the county's interest at heart, and we appreciate their work. Thank you, guys.
Thank you. See you. See you.
Thank you. Steven, who's ever going?
Well, I guess, Steve, you want to share the good news first?
Sure. We'll start on the good news.
There's good news?
Yeah,
Yeah.
just my kind. Not that I need one, but I probably should have one.
I'm on. Okay.
Yeah, we passed out a sales tax update that showed up this morning, and when you receive a number that shows up on the state website you haven't seen in 3 years, I thought it'd be noteworthy. So, and an unexpected increase, so it will positively impact, you know, some of the revenue projection that's in there. And so, you know, we still have some time left with, you know, other things that'll process. Obviously, that, you know, you can see there's still 3 more months on the accrual basis that will be part of FY17. So we take the best picture we can at the time, and you know, but there are things like this that can show up. Unfortunately, this is a positive one. So I just wanted to share it with the committee this morning, so it was good news.
Okay, good. Mr. Siraj?
Thank you, Mr. Chairman. Steve, we've seen this jump starting, you know, early in, you know, I guess would be May and June, and it's kind of climbed. What, do you know the trigger for that?
It's
New industry in town?
the biggest jump for this last payment was in our 1%. So it was the countywide, you know, in the unincorporated area where we get the 1%. That was usually the average is in the 80,000, and it jumped to 200,000 for this particular month. So when I drilled down to try to find the category of what that is, it's about 3 and a 4-page document of categories that it could possibly fall underneath when the retailers send it to the state. So that we're unfortunately not able to get down to exactly what created that.
I'd just like to send them a fruit basket or something.
Absolutely.
You know.
Mr. Lear?
Thank you, Mr. Chairman. At the Economic Alliance yesterday, it was reported that the month-to-month increase in the number of jobs in Kankakee County was 1,000 people. The most recent month reported compared to a year ago. So the increased number of people employed in the county might be one factor.
The 0.25% amount went up as well, but the biggest jump for this particular amount, you know, came from the unincorporated 1%. So.
Yeah, go ahead. You doing it?
Yeah.
You got a question, Steve?
Excuse me, and I don't even know who to direct it to. Would the employment figures still be based on the unemployment figures?
Mr. Lear?
Yeah, the news referring to.
What was being reported at the Economic Alliance was the number of people that were employed. And it was a month-to-month comparison, 1 year, a previous year to current year. So there were 1,000 more people employed in the county in the most recent month reported. Does that clarify it for you?
I believe so. I believe so. Thank you.
Okay, you're on.
Looking at the budget for this year, I wanted to recap a little bit about what our goal as the finance committee and the board is all together. We have shown department heads this yesterday, so they're well aware of where we're at. But it needs to be reiterated just to make sure we have some new members and people that you know are contribute to this committee quite a bit, and I appreciate that. But the TAW ceased at the end of FY19. We have a partners locally with our local banks, the big banks outside of the area. They will not do business with us until we have a zero fund balance, and that's between all three of our funds. We'll get into that in a minute. We've been fortunate to have local lenders step up and help us out while we work out this situation. And it is a bad situation. We all know that, and that might be an understatement. But we must have a zero negative combined fund balance by 12/1/19. That's the end of the FY19 budget year. We don't get any loans as stated after that point, which keeps us going from January to July until we get tax revenue in. Remember, our bond rating is based on all factors, including the audit. So any rating upgrade that outside banks will find sufficient to provide TAWs must come from the FY19 budget year, which means they'll do that rating in early 2020. So really, we need to get it together because they'll look at that number in 2020 and say, yes, you've done what you said you were going to do. You're now worthy. So at that point, we're going out for the FY20 budget, looking for tax anticipation warrants. So I didn't want that lost on everybody. That early part of 2020 will be a challenge for us as well. So this is a best case scenario. If things were better, we'd be able to have this done by the end of FY18, which is 12/1/19. So there is no guarantee that the ICE program will continue. We all know that. That could stop tomorrow. It could stop if there is a change in the president. We have to take advantage of whatever opportunities we have to offset current costs, which is by revenue increase and cost controls, for that to manifest in getting us out of that hole. We have no other sources of revenue, I'm not going to place blame, but the public said no twice to sales tax increases. So this is what we have to rely on, nothing else. We always have to pay for our own prisoners, and that we shouldn't lose sight of that because we have people in this. We're at historic. I don't say historic because I'm talking perspective of maybe 5 years. We're at a very high level. I think we're at about 280 right now, and the sheriff may comment on that in a little bit. Sorry, 283 to be more precise. And usually we're at around 220. That's our normal number that we're looking at. So. That there is a cost associated with that. We can't forget that. That's not just free because that's not reimbursed. That comes right to us in food, in cost to house that extra 60 people. The highway department must be able to operate, and we are, for all intent and purposes, their bank right now, and they're looking at about a year out, and they need their money back, or else they can't do road projects and bridge projects. That's more than just a want to, it's a have to. So moving forward, what are the consequences? We don't get our TAWs, we don't meet payroll, and we fail to meet our pension obligations if we don't do this. Kankakee County bond rating fails to get above speculative, which is a threshold for TAWs from outside lenders. We have to get the bond rating up, our credit rating, in order to be worthy of outside lenders. It means the bigger banks from outside the area. And if we don't get there, there will be layoffs in all departments across everything, and the public services will absolutely suffer. I mean, this is not a joke. It's not a warning. It's not an empty threat. It will happen if we don't get there at the end of FY19. And you can't change in October of 19. You have to change and do things now. So as we look at this, this is the way that Steve and I and other people on the finance committee, when we talk about these things and we meet, we're looking at our 3 fund balances. We're looking at when the outside lenders look at us, you have to be at 0 across the general, the tort, and the pension fund at the end of FY19. So I've highlighted that in yellow, though what you're going to see in the budget now reflects that kind of a positive number in FY19. I do want to draw attention that at the end of our estimated year end, we will have made a $500,000 improvement on that debt. Okay, so we did something very well this year. We're moving in the right direction. We just wanted it to be faster. And sometimes it's hard to make up for, about 8 years of a slide in 2 or 3 years, but we're moving in the right direction. I would have preferred it to be faster. Everybody else, I think, in this committee would have been a larger chunk, but we are doing better. You'll see at FY20, if things continue on the same road we're at, it jumps up even further. So again, that 2.6, we still have a negative in our general fund, but our other funds allow us to have operating capital. So just want to make sure everybody's understands that. And if there's any questions, please let me know, because the next numbers are based on this is what we have to have. This is what we have to do. It's not even a like to. We absolutely have to get to this. Mr. Scott.
And you might just want to clarify where the highway funds, the money we owe highways, is that within the general fund deficit?
That is within the general fund deficit. That's what we have to pay back.
So that is reflecting paying back the highway fund,
Exactly.
so they can continue to operate as well.
Yeah.
All right.
And it's not all at once. It's built into the first line item on interfund debt reduction. We intend to pay them we not intend, we have to pay them when we get taxes in. So that'll come at the end of the year. So they're able to operate for that following year. That makes sense. So can't pay it back right now, or else that's just one less month we're able to operate throughout the cash desert, as we talk about, which is January basically to July. So, any others before I move on? All right. And Steve, stop me if I say something crazy, please.
While we're on cash, as you see, even a negative number with the draft 18, an improvement in those numbers means an improvement in cash as well. So as we lose the TAWs, we have to be able to gain on our own in order to be able to continue to pay bills and make payroll. So just connecting that correlation to to day-to-day operations, especially in the springtime.
Okay. So as you look, there's a couple of things that I want to draw attention to on this. The first thing is that red line. And I will say, let's skip ahead one page. I want you to see the bottom line first. That may make more sense. At the end of FY17, we're projecting, right now, it's an $18,000 surplus. Now, you'll see because of that sales tax, that number might have gone up, 60, 70 grand maybe?
Possibly, yeah.
So, if we have another month like that, it may go, in sales tax, it may go up a little bit more. If other things change where we have increased revenues and decreased expenses over the last quarter, it'll go up even more. But I'll stress to you, it cannot, under any circumstance, go down. Okay? Because there will be no red numbers at the end of this year. We can't have it. So, there's too much at stake. So when we look at that at the end of this year, there's a zero as far as it's a balanced budget. What we're going to propose to you now, that zero in the far right corner. Okay, that's a balanced budget. But if you go back to the previous page, we got rid of the contingency fund or the contingency line item because there is no more contingency. Okay, the budget is what it is. And there is no, oops, there's no more, or over by 10, 20, 50%, or even dollars. I mean, I understand dollars. Okay, we're not gonna go that micro, but we moved everything up into interfund debt reduction. Okay, because that sends a clear message that first of all, the budget is the budget. We are holding this budget firm, absolutely, as a board now. Okay, the contingency, I think, sends a message that, well, things happen. Well, things can happen. On a monthly and a quarterly basis, we're gonna be monitoring this as a committee here, because too much is at stake if we don't take a active role in keeping track of this. There can be no things out of the blue. It has to be documented all the way through for the next 2 years. So, and further, frankly, but we'll just talk about that. So the numbers are the numbers all the way down, but the 1.534 million manifests in debt reduction next year. Again, we can't dig out of the hole all at once, but we need to take 2 big chunks the next 2 years. We have no choice. So, is there now within this? It's already built in because, and I want to take a second to step back. I want to thank the Laborers Union for actually ratifying the contracts that we had on there for the recorder, treasurer, auditor, and also coroners. We didn't get them back in time for this meeting to approve it, but we do have other labor agreements that are agreed on that they're going to be voting on as far as labor units. We've built in those agreements into this budget. So we've already got those numbers in, and we're estimating for ones that aren't agreed upon at 2%. Okay, because you see how close we are. And so that's kind of what, while I'm not going to negotiate for those other departments right now, I'm just saying we had to account for something in these budgets, and that's what we're accounting for. So if you're moving forward, that's just for the labor part. It's not for the overall department expenses, in case some of the department heads were wondering about that. So I guess any questions about any particular line item, anything here, anything that they want to talk about this year or next year? And I'll give you some time because there's a lot of numbers here. I know we emailed this out, but Mr. Scott.
No, thank you, sir. The central services line item that has a decrease of about 25%. What's included in central services?
Steve can give you the full breakdown and talk about why the reduction.
In the master document, there is a breakdown of capital development and central services. It covers maintenance contracts, primarily the audit and the postage machine are the 3 main items in that area. And the reason it went down is that some of there was some paper and some specialty things that evolved to be in charge there that am I stating that that's no longer going to happen in central services?
Exactly. Exactly.
Thank you. Again, in the original fiscal year 17 budget, we put aside $500,000 for interfund debt reduction, which unfortunately has not been realized because budgets have been blown past, correct? So, and I know you mentioned earlier that as a board, we have to hold to our budget. How are we going to do that moving forward to make sure that we can get on track for not only the employees of the county, but frankly the citizens of the county and the future of the county, to make sure we are in decent shape in 2 to 3 years?
Sure, I can tell you that from my perspective and this committee's perspective, this will be ongoing monitoring of real-time data. Okay, this is not something where we can check mid-year and then, because if any changes need to be made, those are months after until those changes manifest, and then they're larger changes because of that. So as we go through, I'm going to be tracking overtime on a paycheck to paycheck basis. We're going to be tracking all of the invoices. We have a problem because we don't have a purchase order system per se. We're not like a business where a PO is entered, then it's cut, and so I can get a snapshot of what's out there as far as receivables. That's just, we don't have that. And those are very expensive. So it's one of those things where we don't have the money to save money, if that makes sense, because I was thinking about that, where we don't control that kind of spending, but we have to account for it, to your point. So the connection that we're going to have with all departments, even the ones that are larger parts of the budget, is going to be closer than ever. There's too much at stake not to have that happen. And so much of what our committee structure will be are things that, and the last slide here will be talk a little bit more about this, but there won't be any hiring. Okay, there will not be any more vehicles that are ordered. There won't be any more, anything. If a new, like, something hits that we didn't foresee coming, a new expense, then that is going to have to be accounted for within this framework. We taking control is not the correct term, I guess, but it's really, we have to take control of the budget, and as much as the statutes allow us to do so. So I hope that is sufficient, but with this is a working committee for the next 2 years in this aspect, and I apologize for the length that the meetings will go as we go through this stuff. We're not line item by any means, but we're going to have a lot to work on.
And then from a department, thank you. From a department head's standpoint, this is obviously public information. What interactions have the department heads had in the say of this budget? And has there been any major objections to date by any department heads in regarding their allocation of funds?
Define major. No, I'm just kidding.
Well, I mean, there's not anybody out there who would who wouldn't like more money. Obviously, I understand how that works. But I guess my question is, historically in the past, sometimes budgets have been put together without a total agreement by department heads, and whether they may not agree with but they need to understand, because we're not taking control. We're just going to start holding accountable.
Sure.
So I just want to make sure that there isn't any huge misalignment by a department head, and they fully understand that this is their number, not because we want it to be, but frankly because it has to be.
To your point, we met yesterday, and while it was a cordial conversation, and we all do enjoy each other's company, that it's a difficult conversation to have. Within the guidelines that we have and the things that we're able to control, we will control. And those elected department heads, within their guidelines of what they have to control, they will continue to control. But we're on that FY19 road together, and the impact will be felt by everybody. Now, there's some small discrepancies, like, hey, it should be a couple of grand more. You've got this wrong because my agreements will cost me this. We're talking over. We had a month to work through just those little movements. But to your point, like, well, I don't know if Sheriff Downey has any comment on this. We did talk about this stuff, and I don't know if now's the time for you to address that. That kind of talks about the question that we were talking about earlier.
I've got a lot of comments.
You do?
Yeah.
All right. Well, there's a microphone right over there. Oh, okay. I don't know.
Pick a side.
Pick a side. All right.
You can elbow me if I say something on a line.
You got it going.
Do I need to flip my coat back? Good morning. I'm sure, and the chairman mentioned it briefly. I don't want to say in passing because it's an important issue, but he talked about the overtime. And I have I don't want to say lengthy, but I'll move through it pretty quickly because I think it's important that you hear directly from the department head as to what's going on with our number. Because obviously, if you look through those numbers, I think overall as a county, I think all the department heads should be commended for doing what they have to do, providing the services they provide, and staying where they need to be. And I think that's important. Obviously, if you look at ours, and I'm certainly not going to back away from it, but because there is some explanation that I think when you guys walk in the room and look at this number, rather than you walking out the door going, oh, geez, what the sheriff's doing, I'd rather you hear the explanation so when somebody questions you and says, hey, what's going on, you know. And you've heard it here, and you've heard the future of where we're going with that number and why it's where it's at. So I'm sure you're wondering about the projection of 10.6 million on the correction side. We still feel, as the chairman mentioned earlier, that those numbers are probably projected a little high, and those are projected high for a reason. because we'd rather project high and come in low rather than project low and come in high. So we did project that number a little higher than what it was. To give you a little history, our 2016 actuals were 8.8 million, and I'll just use rough numbers. The original 2017 budget that we were given was 8.5 million. And in June of 2017, that number was brought up to 9.2 million because we knew that we had ice and we knew that we had some things going on. Now, one thing to remember, or one thing to consider is, by June, by the time that number was bumped to 9.2, our budget was already at 6.6. So that was a number that 9.2 number was a number that we probably weren't going to make anyway. And so based on the projections in April of where we were at and where we thought we'd be, was going to be about 10.2. With the additional revenue coming in, the chairman felt that was a pretty good number that we could shoot for, and where we hoped that we would end up. Based on our projections today, obviously the 10.6, that is a 4% increase over the 10.2 number. Now that doesn't sound, 4% doesn't sound like a whole lot, but when you're talking about $10.2 million, 4% adds up pretty quick. So the question is why? And I will hopefully answer that to the best of my ability today. As I've said in about every criminal justice committee meeting, every finance committee meeting, with revenue comes expenses. We all know that. I realize that there may be some who want to reap all the revenue without the expense. I want that too, but we all know that that's unrealistic. I'll give you figures for the benefit of this program at the end so you have some idea where we're at when we compare locals to out of county. So back to why. Dating back to October 5th, 2016 is when I received the call from the Chicago field office director asking us if we had beds available to house ICE detainees. At that time, our staffing had been decimated by layoffs from 2014, attrition from other corrections staff resignations, and not replacing them to save money. Because if you recall, back in 2014, 2015, we were looking at every nickel that we could potentially save, and by not replacing, when 80 to 85 to almost 90% of our cost is personnel, that's really the only place that we had to save. So we did what we could to not replace people without putting our staff in jeopardy, obviously. That's important. Rule number one is officer safety. So those numbers put us behind the 8 ball immediately. 3 days later, on October 8th, we received 75 ICE detainees. Jail administration, correction staff, jail medical staff worked tirelessly to get ICE off the ground. I think I've said that in a number of meetings, the work that they've done that I don't think anybody in this room besides those involved know what they did to get this program moving forward. They didn't work tirelessly for their own satisfaction. They worked tirelessly for the benefit of the county. For those with short memories, last October there were not any other revenue streams coming into the county's general fund. Correction staff worked overtime daily on all 3 shifts. So much overtime and mandation that the union filed a grievance. It was literally becoming an officer safety issue. Jail administration began testing for COs immediately. However, the hiring process takes time. We reached out to former COs. We reached out to former part-time COs. We work constantly with Kankakee Community College, Olivet Nazarene University, who both have exceptional criminal justice departments and a number of students in there that are close to becoming into the real working world of adult life. Over the first 5 months, we increased our staff to the point that the union withdrew their grievance. So we got some numbers in, but that did not reduce the overtime. It reduced a lot of the mandation. Since last October, we've tested over 30 times. We tested over 400 prospective correctional officers. We've hired 40 correctional officers out of those 400. That's 1 out of every 10 that tested is the number that we were able to hire. We were not going to hire just to hire a body. We were going to hire people who we knew would do the job, who were a good fit for the job. They weren't friends, they weren't family, they weren't anybody other than those that applied. And we wanted qualified people because these out-of-county details are important to this county. In addition to those 40 we hired, 13 of our original correctional officers resigned, retired, or by mutual agreement, we parted ways. I could talk about the overtime for another hour, but I don't want to bore you. I know that you've got more important things to do. I just want to provide board members with the information that you need to know as to why that number is 4% over that 10.2 number. We were short-staffed before and after we booked in our first ICE detainee. Along with the hiring and the overtime, there were the uniforms, there were the FTO training that the staff has to go through before they're even allowed to work by themselves in the jail. They attend 5 weeks. They're mandated to attend corrections basic training in Springfield for 5 straight weeks, of which we pay them 5 straight weeks. We then have to pay to backfill their position at time and a half. So in a sense, for every correctional officer that has gone to training, we were backfilling every one of those positions at double time and a half. We had increase in food costs that we knew we were going to have, obviously, with more inmates and detainees. Medical, both staff and treatment. To give you an idea, and you know, while we don't pay for any out-of-county medical other than our medical staff that are in our building, and this just happened last night to give you some idea, and it's happened more than once this year. We had a fight in the jail yesterday. Guy got hit in the face, hit in the eye, did some damage to his eye. He was at Riverside Hospital. Riverside moved him up to Loyola. This is a local inmate. This is not an ICE detainee. This is not a U.S. Marshal. So we have our staff going to Loyola 3 shifts a day, which takes them out of our building. We're responsible for that medical care. So those are, you know, when we talk about costs that aren't accounted for and we can't budget for, those are the things that the chairman mentioned. Sometimes those things happen, and we have to work around it as best we can to still meet our budget number, which we obviously intend to do. And lastly, our increase in local population that Andy, or our chairman, already stole my thunder. In December 2016, our local average was 203. In October of 2017, our local population was 269. So far in November, our average is 283. That affects our bottom line on that side of the budget. So why is our local population up? We have a state's attorney who is doing exactly what he said he'd do. He's locking up bad guys. He's locking those up that need to be locked up to make our community safer. And that's exactly what he said he would do. That was something that, while somewhat anticipated, I don't think we realized the volume that we would be at with locals. Bonds are higher. People aren't bonding out because the offenses they're committing are serious. Those higher bonds keep those that are locked up, and keep our community a lot safer. So after all of that, what is the benefit of our bed rental program? 2 years ago, when our numbers were down, questions were being asked, is the program worth keeping? I think the chairman, he wasn't the chairman at the time, but the guy sitting to my left literally said, what's the tipping point? Did you use that term? Yeah. At that time, we didn't know. But I know that we as a department went through and we calculated out the cost, because it's hard, it's a difficult number to come to. But when you calculate everything, including jail operating costs, utilities, IMRF, benefits, what portion goes to the local side, what portion goes to the out-of-county side. Back then, in a bad year, the county was saving local taxpayers $2 million from housing their own prisoners. That's quite a benefit that I don't think, and you don't realize it because it's not an exchange of cash that you see. It's what we would have spent had we not had the program. So this year, with ICE, with our 4% increase in our budget, the cost savings of the taxpayers right now is $3.6 million that this county would have had to come up with to house our own inmates. And I think that's an important number that everybody needs to keep in mind. Question I have for you is, without $8.4 million in revenue, where would the county come up with $3.6 million in looking at the numbers you just saw? A lot of credit goes to Chairman Wheeler and this board. You've allowed us to do what we do. As I mentioned already, the department heads all of us have worked our tails off to get where we're at. And it's not where we want to end, but we are heading in the right direction. We will continue to work together from our office to the county board to move this in the right direction. You see where the number is for 2018 in corrections. We feel like our overtime number has dwindled significantly. We are still in the process. In fact, we have tests going on today for corrections. So we are continuing to work, continuing to move, continuing to get to that number. So, you're talking about reducing our cost, $800,000, and still trying to maintain the ICE standards, the county jail standards, and everything else. So just a quick, it wasn't quick, but just a update on where we were at and why, when you look at that number, going, what the heck? And some of you may not say what the heck, but some of you understand. So if you have any questions, I'd be happy to answer them. If not,
Mr. Chair.
Thank you, Mr. Chairman. Thank you, Sheriff, for your presentation. Being on Criminal Justice Committee, I hear this a lot. But I appreciate for these members to be able to hear that. But I just want to clarify one thing that you said in your presentation, and I don't know if you misspoke or something. But you said time and a half and then double time and a half. What's your overtime rate? Is it time and a half or is it double?
The overtime rate is time and a half.
Okay.
But remember, the ones that are at school are getting paid straight time, and we get no benefit of them other than them being trained.
Right. But
so in a sense, you're paying double time and a half.
Okay.
To fill that spot.
Thank you for clarifying that for me.
Mr. Scott?
Oh, thank you, Mr. Chairman. Sheriff, thank you again for everything you guys do, your whole team. You're right. It's a great revenue source for the county. It's brought us through some, pretty bad times. The question, how do you feel about your 9.8 number for next year, your budget number? I mean, obviously you cannot predict the future. You cannot predict who's going to come knocking tomorrow, but what are your thoughts on that 8.9 budget figure?
Well, I'm smiling. I'm smiling because that's the number we gave to them.
Okay.
So
no, and that's what I want to know.
Yes.
And I think it's important.
Yes, that's the number we gave to them.
Good.
And so we feel comfortable.
That's good because
best case scenario.
Yeah. Good.
And again, we're looking at some possible increase in revenue and some other things, but yeah, we gave them that number. So that's not something they came up with. It's not something the chairman and the finance director came up with. That's a number that we came up with and presented to them.
Great.
So to add on to that, we did not come up with it. We agreed to it. So that's important because none of this works without those numbers being there along with revenue numbers. So I hope that's important. It wasn't just like, okay, sure. It was like, this works with that. And it doesn't work without that. And the only wild cards are if unforeseen expenses come in from any direction, or unforeseen revenues come in from other directions. But I think you've seen that the hole still needs to get filled. So we couldn't spend excess revenues on more expenses. Does that make sense? That's why it's month to month, week to week, quarter to quarter monitoring that'll get us through this together. And I look at it like a partnership, and I hope we all do, because we can't do this without each other. That's the entire gist of all of this conversation. So go ahead.
Ron?
Thank you, Mr. Chairman. I'm new to this committee, so I might ask a simple question, but I'm somewhat concerned when I hear that the sheriff agreed to the $9.8 million. Were you involved in the $9.3 million budget number? And did you approve that? And I'm just trying to get my hands around the discrepancy.
We did with the added expense, but knowing where we were at 6.6 already, I mean, we could have certainly asked for more, but at that point, we definitely agreed to that 9.2. But then knowing the additional revenue that was coming in, that there would be additional expenses, both the chairman and myself agreed that we'd be around 10.2.
So is the difference between then and now
I believe, and I may be wrong, but most of the overtime was consistently, up there throughout the entire year, but most of the sunk cost and any infrastructure changes we needed to make or any of the other things, that was at the first part of the year, I believe. And you may correct me on that, but I think we're there on that situation. As far as any changes at the facility that needed to be made, upgrades, if you will. There may be an outdoor rec area that comes down the pike here, but that's minimal. That's not much at all. We're not talking even, 6 numbers. I mean, that's much less. So,
yeah, the majority of that overtime was all pretty much up front, as I explained about the trying to get people hired. As we have gone further throughout the year, that number has dwindled significantly, and that's kind of where we're at now, knowing that we've still got a couple, that we got some openings still, and once those people get started, the overtime is going to continue to drop. So that's kind of where that 9.8 number came up with that, where we came up with that.
Serious?
Thank you, Mr. Chairman, again. So how many more COs are you going to need to hire to get to where you're going to be fully staffed to handle all and minimize the overtime? It's a lot easier to predict straight hours than it is to predict overtime hours.
I believe we're at 119, Chad. Is that the number we're at now? And back in our, I don't know if to call it heyday.
Well, but you didn't have ICE in heyday.
We did not have ICE, but we had more marshals. So the out-of-county number was similar. So, and it's all based on housing, how many you're housing here, how many you're housing downtown. So
15 extra?
I don't know that we'd go that high, but I would say it'd probably be less than that. Probably 8 and 10 maybe.
The number that we always looked at was about 125, was about the number.
To be able to staff both jails, handle
just historic numbers.
Right.
Yeah, we were probably, just because, and see, I think, and I guess the one thing that I didn't mention, just because, I mean, every department deals with it, although we probably deal on a bigger scale because we have more people. That 119 number, and any number that we started with, and any number that we had during that time, whether we went up from 70 to 75 to 80 to wherever we're at, doesn't include, we may say we've got 119 now, but that doesn't include, 2 off on FMLA, 2 off on work comp, others off on injury for whatever reason, maybe they got injured away from the job. So you're always dealing with 5 to 6 people less than what the number is we're telling you because of those things. So.
Okay. Anybody else? Mr. Mulcahy.
Thank you, Mr. Chairman. Sheriff, what is the capacity for ICE detainees now, and do you think that I guess just what's the capacity and how close are we to meeting that?
We are at, our capacity is 200. Mm-hmm. We averaged last month, I believe we were at approximately 140 by the time it was all averaged out. So our high was 192. I think our low is 115 or so. So we're, it depends on the numbers that they're moving around.
Sure.
And we don't know that from
You don't
day to
have a
day.
feeling for,
I don't see it going down.
well, that's good.
So
Hope you see it going up.
I can't predict that either. But remember, when we started getting ice and everybody, we're talking about presidents and we're talking about who the president is, and we started getting ice in October when, for all intent and purposes, everybody thought Hillary was going to be the president. So they were coming here before there was a change in the Oval Office. So I don't know what it's going to mean in the future, 4 years or 3 years from now. We'll just have to play it by ear and keep doing what we do to make ourselves attractive.
You just don't wake up like that.
I don't wake up attractive. Appreciate your time. I apologize for taking some of the meeting that is designated for other things.
No, that's fine.
So now that the sheriff is done, I'll fill in. I believe part of Mr. Scott's additional question, part of the communication, Chairman Wheeler asked me to communicate to the department heads that the FY17 amended budget would be the starting point going forward, and if there were any changes, to please let us know the detail of what those changes would be. So all the department heads, had the chance. A lot of them, accepted that number. There might have been some small changes here and there, but everybody had the chance to input and go through what's in there, as well as in all the special funds. We created spreadsheets, interactive spreadsheets for them with the fund balances and everything, and sent those out and for their interaction, and they sent back, which is also included in the main document for those departments that have special funds and they interact in them. So there is a lot of detail behind the scenes that takes place, a lot of communication that comes to the the summary and the budget document that you have before you. So
I did think it's probably also good that we mentioned to this committee, and I'm sure some department heads aren't going to like that and haven't liked it, but there was a lot of budget asks that didn't get fulfilled based on what our reality is. So we had substantial amounts of asks in some cases that just are not possible under the realm of things. And for the most part, I think I'm waiting to hear back from one department head, but for the most part, I think people get it. They understand what's going on. So, but again, the communication was there. So with that, I'll just move on here. In summary, the county board's going to enforce the budget by every legal means necessary in order to ensure the adherence to the budget allocations. That's where we're at now. We have to do what we have to do. If at any time during the year it becomes evident that there's an over budget trend, or if new expenses are incurred by the county, the board will take immediate and decisive action in order to correct the overage. That's what our job is now. It's just necessary. There's no contingency budget anymore. As I mentioned, every dollar is critical. There's going to be no hiring, no new vehicles, no unnecessary travel, conferences, very limited overtime expenses, and expenditure controls in all departments will be implemented and monitored by the board, and specifically this committee. So I just wanted to reaffirm that we're the heavy lifting committee, and we need to communicate with the other people who are not part of it and encourage them to come if they want to be part of this. We're not going to dominate over departments, but we're just going to be the accountability place. So that being said, any questions for me, Mr. Mulcahy?
Thank you, Mr. Chairman. This goes into effect our new budget year, December 1st, because from what I understand, the hiring process is being looked at by a department head or two. So, and I know they're critical hires, and I know you know that, but.
Right, and yes, and we can't have anything impact this year or next year. So the year-end budget numbers are for those departments, are what they are. And I'll talk specifically, Mr. Regas, with the chief judge coming and telling us that we're starting to fall behind on some things that we need to make sure we don't fall behind on. There is a mandate there that this board needs to pay attention to. because there's very few people that can tell us exactly what to do, and the chief judge is one of them, especially where it comes to money. So, and the way the courts operate, for good reason, by the way. So in that case, yes, so that is going to happen. There may be a little bit of overestimation in that department because somebody is going to retire. And so the replacement has been hired to learn the office. So, but there were some other asks that will not happen.
Thank you.
Yep. And that's one of the reasons actually we said, wait until the budget is done before you actually hire anybody. Because go through your interviews, identify people, but with so much of the health insurance and the other things that were still out, a major portion of our budget was still out when those asks happened. Does that make sense?
Yes.
Okay.
Ms. Weber, do you have anything?
That was the same question that we've, by week, we've heard people ask us, we need people, we need to hire some people. We did say put it in the budget. That was my question. Is it in, are they in? They're not there.
No.
So that was the question. We've heard 3 people, 2 people, 1 people, no people.
Right. The only, let me think here, we did, the ones that we approved are there. Does that make sense? The ones that we voted on and approved. The ones that we said hold off are not there. Because we, at the time, we were like, we don't know what's happening here because we had so much of the budget still out. Health insurance, we saved $400 and some thousand by the changes that we made. And not saved as we were gonna have to pay it. And instead we went a little bit the other direction and allows us to be solvent, if you will. But those ones we specifically said hold off. That it's not included. There's no way to include it. You see the numbers.
And it's not vital to their offices?
Vital is probably subjective. And while I get it, the numbers are the numbers. I can't make something up that is not real. You know, if it's vital. Thank you, sir. I knew you were here for a reason, Mr. Olta. He's my microphone guy. No, the vital is subjective, and while I understand that, we have to do what we have to do. And I know that many departments would like 1 or 2 more people and see that as vital. There's nothing that this board can do about it.
Oh, excuse me. Go ahead.
I thought that when we were talking about insurance, it was that it was going to be the employer, the county pays $3 million and the employee pays $1 million, making it $4 million.
Mm-hmm.
Why does the budget have health insurance at $1.8 million?
There are other special funds that pay their own way in that, so.
In the $3 million?
Yeah, so the way it gets broke out, that's the general fund
Gotcha.
portion.
That helps a lot. Thank you.
Mr. Stoffman?
Thank you, Chairman. Andy, is there any anything in here for what might happen with the Will County Detention Center? Either pro or con, expenses versus nothing? Okay.
No, I made sure that we made a mistake a couple of times where we put wind farms in there that didn't show up that year.
Right.
So there is possibilities that we will see. We have interest in solar farms. We have some things to work out with Will County on the detention center.
Okay.
There are possibilities, and we're going to keep going with those. I can't count on it.
Yeah, I know that.
Yeah, we can. So.
Thank you. Anybody else? Okay, so we need to take a vote to recommend this to the full board?
Yes, to adopt. Yeah, to adopt it.
But yeah, it goes on file for
Oh, it goes
15
on file.
days, so there'll have to be a special meeting at the end of the month. to
Okay,
approve
I
it.
need a motion to approve and adopt the FY 2018 tentative budget. Mr. Vickery and Mr. Vickery with the motion and Mr. Scott with a second. That would be 2 gyms, and the 3rd gym almost got in. Okay, you're all set.
Mr. LaJeffs.
Aye.
Mr. Vickery. Mr. Stauffenberg. Mr. Hess. Mr. Mulcahy. Mr. Scott. Mr. Searoy. Mr. Hildebrand. Mr. Einfeld. Ms. Weber. Mr. Payton. Ms. Dunbar. Mr. Ritter. Mr. Kinzinger. Mr. Wheeler.
Aye.
Motion carries.
Oh, yeah. Okay. Andy is done, Steve's done, I guess, oh, gotta sign this before you leave. So I'm not gonna entertain a motion we adjourn till everybody sign this. I'm wielding power is what I'm doing. Or yielding, probably. Okay. Mr. Altoff left. I was gonna give him the privilege of adjourning the meeting.
He's not on the committee.
Oh, he's not? Oh. Well, then I wasn't. But I have trained an individual very well. Yes, and he can now adjourn with either hand. Okay. I'll take a motion to adjourn the meeting. Mr. Mulcahy, need a second? Miss Dunbar, just to show you that I'm not a chauvinistic pig. Oh, I'm not supposed to say that.